Fed approaches interest rate cut in September. On August 21, the Federal Reserve, Fed, released the minutes from its July policy meeting. According to the minutes, most Fed officials are leaning towards the possibility of easing monetary policy for the first time since the COVID-19 pandemic began. This is a significant signal for the market and investors, indicating that the Fed may be preparing to reduce interest rates in the near future. The market is currently anticipating that the Fed will cut rates by 25 basis points, 0.25%, in its September meeting. If this occurs, it will be the first rate cut since the onset of the pandemic. Currently, the U.S. reference interest rate is held at 5.25 to 5.5%, the highest level in 23 years. This change would have far-reaching implications for the economy, from boosting consumer spending to lowering borrowing costs for businesses and individuals. Fed Chair Jerome Powell provided important insights during a press conference on July 31. He emphasized that easing monetary policy could be a reasonable step if economic data continues to show stable trends. Although the 12 members of the Federal Open Market Committee, FOMC, the body responsible for setting interest rates, voted to keep rates unchanged in the July meeting, some officials expressed the view that an adjustment in July was feasible. They argued that recent economic indicators, including declining inflation and rising unemployment, supported an early adjustment of 25 basis points. However, the current economic situation is also presenting challenges. Recent data shows that inflation is gradually moving towards the 2% target, and most Fed officials expect inflationary pressures to continue decreasing in the coming months. Nevertheless, the labor market is facing difficulties. The number of new jobs created last month was only 114,000, significantly below the forecast of 175,000. The unemployment rate also increased to 4.3%, the highest level in 3 years. This suggests that the labor market is weakening, which could put additional pressure on the economy and intensify discussions about reducing interest rates. This data has led many Fed officials to consider that a monetary policy adjustment might be necessary to alleviate concerns about economic weakening. Some have even suggested that the Fed might need to adjust rates before the next meeting to avoid more severe economic downturns. This adjustment will depend on the evolution of economic indicators and other factors impacting the global economy. In summary, in the current context, the Fed is approaching a crucial decision about cutting interest rates, which will not only affect the U.S. economy but also have global implications. A rate cut would facilitate economic growth but must be carefully considered to avoid unintended side effects.